Hi, everybody, and welcome to this talk at Digital Dragons about gaming, M&A, and fundraising. My name is Alina Soltys, and I'm a founder and partner at Quantum Tech Partners. And today we're going to be talking about the hyperactivity we're seeing in the game space, as well as some things for owners, operators, founders to be thinking about when they're going through an M&A process, or if they're thinking about considering going through an M&A process. So a little bit about us. Quantum works with gaming companies all around the world on a couple of key things. We represent companies in their conversations around M&A. We also help companies go through fundraising and strategic types of partnerships around the world. Our team has closed over 65 transactions across gaming and tech. And we've been longtime supporters of independent developers, technology providers, and companies that are doing innovative things in the space. So just a quick overview of what we're talking about here today. We're going to first go through some data and try to make it a little bit more engaging around what it means for businesses. Taking a look at fundraising and M&A data, some of the big transactions that are happening in the space, as well as some of the partners who are doing a lot of the acquisitions. And then towards the end, we're going to talk about M&A and what it means for you. What does a process look like? What are some do's and don'ts? And what do the stages look like, as well as valuations for companies in the games industry. So let's jump in at a high level. Where are we? So the incredible amount of momentum that we've been seeing throughout the gaming space has continued. We're really seeing a trifecta of a lot of activity, a lot of valuation movement that is increasing in the benefit of sellers, as well as a lot of money coming into the space, whether through venture capital or through public funding that is supporting a lot of this activity. There's bulk buying as a result of that by some groups like Embracer, EA, and others that are quickly adding more to their portfolios. And we're seeing it across the globe. So there's a whole batch of new European companies, maybe not so new anymore, that have been actively acquiring. We have the Asian players like Tencent and NetEase that are continuing to be very active through their various subsidiaries. And it's sparking an interesting aspect where all of a sudden we have open public markets where IPOs and SPACs are contributing to a lot of new companies becoming public, raising funding, and de facto becoming acquirers themselves as a means to grow inorganically. And what that really means is a lot of these really great independent studios are drawing attention for what they've been doing really well, their unique products, their unique player bases, and they're attracting the attention of potential larger partners who want to bring them in. So it's been quite a interesting ride over the last few months, and it's continuing to progress really, really strongly. So more specifically, where is some of the activity happening and why is it happening perhaps? So a lot of the acquisitions that we're seeing are both for studios and content, as well as for technology and infrastructure. And now that we have a couple of very large infrastructure players in the space, including coming in from the tech world, in the cases of Sony and Google, they're also supporting and contributing to some of this activity and innovation. We've also seen a couple of ad tech vendors like IronSource and App11 go public. They too are doing their own sets of acquisitions, whether for studios that are doing well or for adding point solutions to their broader platforms. They're also encouraging a whole level of their own type of activity. And then on the right side, there are some thoughts here in terms of where do we see the next waves of innovation, mergers to be happening, and a couple of things that just to mention here. So we are seeing a lot of new game experiences. A lot of them are getting funded, and in a certain amount of time, once those companies have the ability to prove out what they're doing, they will become the next wave of acquisition targets. So that's very exciting. I think what we've seen with some of the new ad changes and just being able to measure user data and player data a lot more effectively, the ability to have targeted player engagement and really capture that data science and that data analysis part is only beginning to become really important now, and it's going to be a very large component of successful game companies in the future. And then the last point here really is, there's a lot of thought around the metaverse and user-generated content. I don't want to be repetitive here, but what we really believe and see is some of the early examples really are just the very initial starting points of where we're going. What, if anything, COVID has taught us is really that games are a social experience. They're a place for everybody to hang out, and the data shows that those who are under 25 view games as their number one place to hang out as a form of entertainment and where they want to spend their extra entertainment hours. So we're just beginning to see this wave move forward in games, as we saw perhaps for the millennial and Gen Z generations using the social media platforms of the day like Facebook that really brought people together. So really big believers in how do you make these gaming environments fun, engaging, interactive, and create those social experiences. So all of this is to say, and we know this, here's just some fun data points that we track at a big level around why is gaming here and why is it mainstream. I think the really interesting parts here are right in the middle of the page with Facebook Gaming's report showing that the new players who came in post-COVID are playing 70% more than the older players, and they're spending over double, over 117% new, like now, versus the older players that considered them mobile gamers in the past. Through some of the antitrust work between Epic and Apple, we've now figured out and found out that 62% of the App Store revenue is generated from games, which is a significant portion. And it's only to say that there's a lot of more focus that's happening on the game space. We have some cool games like Free Fire and Ginseng that have both hit $1 billion marks in their respective downloads and amount of revenue. And so it's just showing that there's a lot of new franchises that are happening on mobile, as well as those that we know that do really well on PC and console that are driving the industry forward. So let's take a look at some data. This is a public peer group of about 20 companies in our index that Quantum tracks. We're looking at the green bars are revenue multiples. So we ended the month of June at 5.6 times revenue, 16 times EBITDA. And the one thing to note here is this group of companies that's public has over $100 billion of cash on their balance sheet, which is very encouraging for future innovation, future deals, and future transactions. As part of that, so if we're looking at M&A on a quarterly basis, we've hit an incredible one-quarter record in Q1. Q2 has continued to be steady in terms of what we've seen in the past. And collectively, if we're looking at first half activity versus any period in the past, we are up over 2.7 times in transaction value versus last year, which last year was already a record year. And volume is also increasing. And this is just for reported transactions with deal values. So it's certainly a very active M&A market that's supported by a lot of different players originating these deals. Why is some of this activity happening? Well, this is just a sampling of some of the recent public credit facilities that have been opened up, new convertible notes that have been added, or just general stock sales happening with these big public companies. And the key message here really is it's very easy to get more capital to grow And in fact, these companies are asking for these credit facilities to be added in real time as they're doing acquisitions. And they're very confident that those acquisitions can get done, that they can raise the money, and therefore a lot of this growth is happening and driving the overall growth in the industry, but also helping drive that inorganic growth that may sometimes keep some of these companies in positive growth metrics versus if they only look at the organic side of things. So let's take a look at some of the largest transactions so far this half. ByteDance has been picking up smaller game studios along the way. They made a really big splash, spending $4 billion on Montoon. We have companies like Bali who not only did the very large Gamesys deal, but they did Monkey Knife Fight and a couple of other deals that shows the expansion of traditional casino players into the game space. And as we're seeing more real money gaming happening, more opening up of sports betting in the United States, this is a brand new opportunity for a lot of players to really make a big position in, and they're going after that. We see EA also spending billions of dollars on building up their mobile side of the business with some pretty well-known, well-tracked types of companies out here. And then Embracer, of course, continues to do a lot of deals. This is their biggest deal in recent few months, of Gearbox being about $1.4 billion, assuming all of the earnouts are completed. But they've been very busy. If we take a look at kind of the activity here, Embracer, EA, Bally's, they alone spent over $8.5 billion in the first half. They're buying a lot of companies, almost bulk buying in some cases. And then we also see a couple of names here I just wanted to point out where motorsport games, they're building up their racing portfolio. You can call them somewhat an esports play. We see TinyBuild, who recently went public in the London Stock Exchange. They also are picking up some of their partners and some of these smaller studios that they know really well. There's a variety of different reasons why some of these transactions are happening, and also where those specific focal points are. In the case of an EA, that's really being targeted in what they're going after. So flipping over to fundraising data. So this is a view as annual totals and then our first half 2021. And you can see that even with a record 2020, which blew everything out of the water at any time in the past, halfway through this year, we're almost at that record level already, which is saying a lot and really leads us to, now we're already at 2020 record levels and we're halfway through August as we're recording. So this year will also be on pace to be a huge, huge year. The other interesting part here is the number of $100 million funding rounds or higher. So we recorded 30 of those types of transactions, which really means that we have a really healthy span of funding coming into companies that are early stage and smaller and maybe make up a little bit less of this total value. And then we're also seeing big companies that are starting to be more mature and later stage, really proving out what they've been saying all along, able to capitalize on that and raise more money. So that creates a very healthy ecosystem for everybody involved, and not that we need it in the gaming industry, but it just creates more proof points for where we can be going and that we should be taken seriously as an entertainment industry, technology industry, and an innovator across all of the different types of markets that we operate in. So looking at quarterly data, this is just a snapshot view over the last 2.5 years. We continue to see this increasing activity. Again, lots of transactions that are happening. These include both smaller VC deals, some convertible notes, some debt raises, So just the ability for companies to bring capital in is how we defined it, and to use for their own growth, whether organic, inorganic, however they see fit. Some of the contributors, we talked about like the public perspective of being able to raise capital pretty effectively. We also have a number of VCs that are focused on the game space. A lot of these numbers are now starting to get old because a lot of these groups are in process of raising funds that are many times bigger than what they first raised. So these numbers will be updating and changing over the next few months. Nothing is publicly announced just yet in some of these cases, but what this really means is we have a really healthy early stage, mid-stage, late stage type of ecosystem of players that are looking to support gaming companies. And these are just the financial players. We also have a whole category of strategic gaming players that also are very actively investing into the game space. So that was the data portion. Let's talk a little bit about M&A and some of the specific things for folks to be thinking about, especially when they've been approached, when they're considering when's the right time to partner up with somebody larger to really bring that right level of growth, strategic benefits, team expansion opportunities. There's a number of different reasons why companies go through M&A. So let's switch over and talk a little bit about that. So this is some data that Quantum puts together on the overall gaming space, and we're pulling information that's publicly available and really looking at it in a couple of different cuts. So number one, we have the upfront portion, which is the top two rows. Number two, we have earnouts. So earnouts are very common in transactions and oftentimes are a very uniting way of pulling together the new team with the older team and really helping them focus in on what's important. And then we have the last row, which is what's the overall deal value look like. What we're looking at is at revenue multiples and at EBITDA or profit multiples. And what you can see here really is the upfront portion for a revenue for the average gaming company is around 3 times, ranges between 1.3 to about 3.8. And then in a total deal setting, we're looking at 2.5 up to 7.5. Now that's a big difference. There are some nuances around the types of content you're making, around whether it's an infrastructure or other type of company. So if you're interested in learning more about some of those nuances, looking at mobile versus PC or console studios, we have that data. Feel free to reach out to us and we can talk more about what are some of those drivers. On the EBITDA side, the upfront portion we're seeing 5 to 10 times. The median is about that 7 to 8 times. And in an overall kind of with earnout scheme considered, that moves up from 9 to 22 times EBITDA with about an average median of about 11 to 12. So when we take a look at the vast amount of experience we've had working with companies across all stages of their life cycle, when we're talking to potential acquirers on behalf of them for M&A, here's a couple of key things that we've learned, seen, experienced, had scars from, that I'd like to share with our audience here today to keep in mind. So let's start with the don'ts. Number one, don't be dealing with one buyer. It's often very flattering to have one buyer at the table who has expressed interest. But fundamentally, at the end of the day, you're only going to see one data point in terms of valuation. You're not going to have that competition element, and you will also experience the timelines and potential dragging out from one partner rather than being able to control a little bit more of that yourself. Number two, especially as a lot of companies are raising funding, the deal terms that you have in place with early investors are super important. You don't want to create any sort of conflicting situations where down the road, if you do need to raise more money, it becomes a challenge to get out of some of those special rights you've granted. It's always challenging to have that money come in, and you need that for growth, but at the same time always remember that it creates a lot of problems down the road if you're not really being thoughtful about it from day one. Another point here really is you're the founder of a game company, whether it's a studio, a technology company, or something else. Running through a process of talking with a lot of acquirers, engaging in those conversations, that's really a full-time job. And what we've seen is people oftentimes try to do it on their own, but the business suffers. And our suggestion is, just as you would go to a dentist to go do your dental work, they're an expert in the field, work with an advisor that is an expert in your industry and in what you're looking to do to really maximize the value, not have an impact on your business so you can keep growing and have the best solutions and options available for you. Part of that too is we as advisors have seen a lot of different things and where the pitfalls may lie with letting negotiations drag out, not having reasonable deadlines in place, not being thoughtful around how to communicate those. Those create problems down the road and misaligned expectations. We also take a look at, from the inside track of due diligence, we're showing our books, we're showing our internal structures and teams to buyers and investors. Especially in the form of buyers, we really do want to do our own homework and make sure that those buyers have good reputations, they're the right fit for our team, they have the right culture, and they're going to be supportive of what we're trying to do. And a lot of that takes place as you're getting to know somebody, but really focusing in and making sure you're actually thinking about that is an important part. And then lastly, don't get greedy. Deals die all the time, and the number of people we've spoken with in the past that said, wow, I wish I had done that deal at that certain valuation before things started changing down the road, never shocks to amaze me. So we have a very strong market today with really clear valuations and very much in the benefit of founders and partners who are growing their businesses. So keep that in mind. It's all about perspective. Some of the things that we suggest you consider doing, again, from running dozens and hundreds of these types of processes, number one, work with M&A experts that have done deals in your space, that have done deals for themselves, and really can bring you the benefit of all that wisdom. We're working with companies and buyers all around the world. If you can manage that, you should also be talking to buyers all around the world. Having one-off conversations is never a good idea. Having everybody aligned in the same timeline, managing them towards the same deadlines, really creates the opportunity for this bidding war to happen that maximizes the value of the company, that gives you a lot of data points around how much the company is really worth, and also who are the right partners. We want to make sure that the right partners are at the table, you're comfortable with them, the team is comfortable with them, and the plan going forward is very crystal clear, and everybody feels good about that. From a transaction perspective, these are some things to keep in mind. A lot of companies are about to be going public or are public, use their stock as part of the transaction. That's really a personal preference around risk and just understanding where the stock may or may not go. What does that timeline look like? So to avoid a lot of the potential risk that you're taking on behalf of this transaction, getting as much cash up front is a good idea. There is a time and place to be aligned with your buyers around earnouts, around performance. So making sure that that is part of the deal as well, and it's easily measured, easily trackable. There's no abilities there for people to play games and stack certain numbers around. That's also one of the key points around creating incentives that work for everybody and create a win-win for everybody involved. And we've seen a lot of these. Again, you want to be working with somebody who understands the nuances as well as some of the traps that come along the way. So those are a couple of things to think about. It's a very important transaction. Oftentimes people are very lucky to go through one of these successfully. So it really is important for you, your investors, and your team to treat it with a lot of consideration and thoughtfulness to get it right. Just an example of how we run the process, we go from beginning to end in supporting the companies that we work with. Generally speaking, a process from beginning to end takes about 4 to 6 months. Really is dependent on level of interest, level of preparedness of the company, the potential market impacts, potential game release impacts that may happen along the way. There's a lot of things that sometimes wiggle those numbers around, but that's where we kind of find ourselves on the average process. We go through the preparation phase with you, really understanding, thoughtfully reviewing, and preparing for conversations with targets. We go through actually conducting the market outreach and having really high impact conversations with targets, and then going through and funneling that interest into a number of parties who are willing to express it through offers, maximizing those offers, validating the partnerships, doing due diligence on the buyers, going into exclusivity, and really managing the process all the way to deal close, as well as aligning for what does the long-term plan look like, making sure that the earnout, the team structure, and everything going forward is set up for success. This is just another view of what does that look like over time and how do we spend time on that. Again, happy to talk through this in further detail with anybody who's interested. And then really just wanted to wrap up here. Thanks for joining this talk. I'm available for any questions you may have. Feel free to contact us, these emails, and hope you enjoy the rest of the conference. Thank you very much.